Hello, everyone. Good morning. Welcome in, Sam. Appreciate you spending some time with us today. We're going to dive into some fun topics. If you're here with us live, please comment below that you're here, ready to get started. If you've got immediate questions for myself, Mr. Kwok here, just what's going on in the world of accelerated banking, also known as velocity banking, go ahead and drop your comments, your questions, and we're actually going to spend a little bit of time going into those questions. So get them in there quickly. And we're going to dive right into really the economic environment today as it relates to the strategies that you and I both teach on our channels, how this election season might either change some things. So I'd love to hear your thoughts, and because I know you and your brother are very active in that world, just very aware of what's going on economically, and I know that kind of helps you just not maybe necessarily have a crystal ball, but at least have a bit of a guidance, how you guys either invest, how you evaluate different opportunities in the marketplace. So for, I would say, a majority of my audience at this point definitely knows who you are. And if you guys don't know who Sam is, I'd love to give you the floor, Sam, just a couple minutes to talk a little bit about you and your brother, YouTube channel, where it started, and go right into today what you see happening in the economic space as a whole and how that affects what we teach. Accelerated banking using HELOCs, PLOCs, credit cards, business lines of credits, offsetting interest, right? Recapturing interest, increasing cash flow, doing all these really cool, unique strategies. Does this environment that we're heading into help us or hurt us in any particular way?
Yeah. So good morning, everybody. Good morning to Denzel. And for those that maybe not know me, my name is Sam Kwok, one half of the Kwok Brothers, co-founder of Accelerated Banking, which is the synonymous terminology we use for many of you may call it velocity banking. I choose to use the word velocity bank or accelerated banking because that's the brand that I represent here in our company. So I first came across the concept of accelerated banking probably in the year of 2016. 2016 is when I was first introduced to it. I think many of you who might share a similar story. I came across the concept and I was super duper confused about what this concept was about. I didn't understand it at first, and I thought, how in the world are you paying off a mortgage faster without directly sending extra payments to the mortgage? Well, later I learned that accelerated banking is essentially paying the principal early with the mortgage, but it's the question of how to do it, right? How do we better manage the cash flow? How to better manage our finances and the different tools that are available that allows us to pay off our mortgage faster by, yes, paying extra, but it's about how we're doing that. So I've been doing this since really 2016, 2017. I've been familiar with the concept. Um, when I even applied it for my own scenario where I was riddled with credit card debt, I knew, having tried this and working this scenario or working this strategy for my own scenario, that it works. And so in September of 2017, I decided to create a video explaining what the concept and strategy is, September 2017. And little did I know it was going to blow up, right? And I later learned that there's huge demand, huge curiosity behind the concept and the conversation of paying off your mortgage early. And then later I learned that it's not just paying off your mortgage that matters to most of you, probably, but it has a lot to do with the fact that many of you may feel uncertain about your financial future. Maybe some of you have realized my 30-year mortgage is probably going to outlast me, or that your mortgage is still going to be around even beyond your retirement age. So that might be some of the fear, some of the concerns that you have about your finances, let alone your mortgage payment could be and is probably the largest amount of your budget every single month. And that might be weighing down your retirement and financial goals. So yeah, I'm excited to share what I see the next 6 to 12 months for accelerated banking as a concept. And yeah, I'd love to share my input as far as what's happening, some of the misconception. Want to clear the air, so to speak, as to what a lot of content creators are talking about. And so, yeah, I think this is a great opportunity for you and I, Denzel, to share some and trade some insights for sure.
For sure. So I'm gonna allow you to dive right into kind of what you see going on and how it directly impacts what we do here today and those who are
Yeah.
already practicing the concept. So comment below if you are already practicing
Mhm.
this particular strategy. What is your tool that you're using? Are you using a first position HELOC? Are you using a second position HELOC? Are you using a PLOC in combination with credit cards? What exactly are you currently doing if you are practicing accelerated banking, velocity banking, and if you're getting ready to do the concept, also share what have you applied for in the comments while Sam gets into
Mhm.
what's going on in the marketplace today, right? And then once you go through that, then we can also dive into what your company specifically is doing to provide a greater impact and influence in this
Mhm.
particular space and provide more clarity, more education to really help people that, as you mentioned, that first discover this concept. it's it can be very confusing, it can be very complex. What I often witness with my own clients is they're confused up until a light bulb goes off, and then all of a sudden they just get it, right?
Mm.
So it's like in other trades or in other things that we learn, typically it's like a slow build, right? You're really bad at it and then you get better. But when I typically work with clients, it's like they just don't get it until I say something a certain way, or they watch someone else's video, yours, Christy Vann's, VIP Financial Education, Akana J. Wallace, who knows. Someone says something specifically, they use a particular story to explain their point, and then they just get it. Then from there, anything else I tell them, they start to take action with it. Up until then, there's a lot of hesitation. So I know
Mm.
you're doing a lot of work in helping people close that gap to when they get that light bulb moment. I know for
Mhm.
me, when I first discovered it at the end of 2017, it was kind of the same thing. What was interesting for me though is like I was already sort of doing the strategy. I already
Mm.
had a personal line of credit for $3,000 at 18 years old. No one told me to get it. I just
Mhm.
was I just acquired it at a local credit union in my state here in South Florida, and I had a credit card, and I was doing the strategy, not knowing what I was doing, but it just kind of made sense. And then once I had someone explain, I was like, oh wait a minute, oh maybe I could do that a little bit better. And then light bulbs went off, and then fast forward 2024. So from 2017 2024, I've pretty much been doing the strategy for many different reasons, right? Many different
Right.
to solve for different solutions, right? So I'll pass
Right.
it to you in terms of what's
Yeah.
going on in the world today, what you see, and then go into what your company specifically is working on to improve this space.
Sure. No, and Denzel, I would love to hear your thought as well, just because, I think all of us who either share, teach, advocate for the strategy, we all have a little bit of different nuance and perspective as to what's happening, right? And we work with different types of clients, we work with different types of scenarios. So I love hearing, diverse thoughts about what's happening. Here's what I'm particularly seeing, and again, I love to hear Denzel's as well. What's been uniquely challenging for at least us, and I can't speak for everyone who's a practitioner or who advocate for the strategy, is over the course of 2023, I think the 2023 and even partially 2024, one of the most challenging, um, I wouldn't want to use the word narrative, but one of the challenging, I guess, narrative, I guess I will stick with that, is that we had a pretty short period of time where the interest rates were skyrocketing like crazy, right? And that was all to fight inflation. It was what the Federal Reserve was doing. So, arguably, one of the challenging things to overcome as practitioners and advocate was the question of, well, what about interest rates, right? I have a 3.5%, or some I meet 2.5% fixed rate mortgages, and many of them, ask that valid question of, how does it work with a 8% or 9% second lien position HELOC? So it was a very interesting time in 2023 and 2024 to have to overeducate on that. On It's not necessarily that we're fighting a battle with interest rates, or it's an interest rate game itself, which can be a factor for sure in some instances. But this strategy, accelerated banking, is not about interest rate versus interest rate. It's about time imbalance. How do we decrease the time imbalance of the average daily balance so that ultimately the cumulative interest cost is lower, even though the interest rate might be higher on, say, a second lien position HELOC. So that's the past. And I explain that because it's a context to what I'm about to share. And that is literally next week, or what we hope to be is next week, the Federal Reserve is supposedly announcing a potential rate cut, a federal fund rate cut. And that's exciting for many reasons. For one, it signals, at least from a macroeconomic perspective, that we may have been successful in fighting inflation. And, obviously, the cumulative inflation increase is still there. I mean, we still obviously have 50% increase on food costs and 30% increase on energy costs, right? We can't go back unless we have deflation. But fortunately, the inflation of 8-10%, those days are hopefully over. And what we're anticipating is a long-term inflation target of 2.5-2%, which is what the Federal Reserve is wanting. And so when the interest rates drop, what we would like to see happen is also the interest rate cost on credit cards, lines of credit, those to decrease as well, which is great for everyday consumers like you and me, where we go, grocery shop or whatever the case might be. What we hope to see is that the vast majority of the cost for line of credit will go down. And I hope this to be true for as well as people who have balances on their credit card, that lowering the interest costs will give them a little bit more of an edge to help fight credit card debt, which is something that I'm a huge advocate for as well. So the interest rate being cut, hope to see, 25, 50 basis point. If it's 50 basis point, great. It's even more accurate cut or aggressive cut. And I think the Fed has announced, or at least is implying, that they will cut three additional interest rates throughout the next 12 months. So very interesting, exciting times for both who are buying homes, but also who are looking to get into the accelerated banking strategy, because it just means additional cost savings over the next 12 to 18 months. So that's what I'm seeing, just from a high level. I mean, I don't know if you share the same insight, Denzel, but maybe I may have missed a
Yeah.
detail or two.
So, real quick, just taking it to the whiteboard, you first brought up interest rate. And typically, when we come across this strategy, people are comparing their mortgage to the potential HELOC that they're looking at. So quite often it's, rate versus rate. And not that you're evading that question, that genuine question
Right.
clients have. You're just simply saying there's something more important than the rate majority of the time. Like for me, I typically have, and you can chime in on this if you agree, but when I'm working with new clients that are acquiring, whether it's a HELOC, right, a personal line of credit, first or second on the HELOC, I typically inform them to, look for rates below prime, right? So I'm always like an advocate of like, the rate's not as important, but if I can find the best HELOC, and if it only took me an extra week or two to do that research, instead of just going with the first bank that they look up, like Bank of America or like some big bank, and I'm like, hey, there's a local credit union around the block where you live, or about 5 miles, 10 miles out where you live, and they're doing an intro rate, zero closing costs, and then it's prime minus a certain percentage. So I'm always saying prime minus whatever the percentage is, and then some sort of intro rate tends to look very, very attractive. And I usually say, hey, I want to use your credit to get this first, right, which is our main tool, right? Or main debt tool. I know I've heard you use that term before, the debt tool, and we're specifically referring to the banking products that we're using, right? So I have them go after this first, and then maybe a 0% credit card to attach to
Mm-hmm.
the line of credit, right? So I'm like, get your main tool first before we apply for 2 or 3 credit cards, right? That's typically how I'm educating clients to find the
Right.
best tools for them. And then if I do have someone with those low rate mortgages in this particular space, if the line of credit is more than double to triple the rate, like if it's triple the rate, quite often I'm telling them, hey, I don't know if I love that. Like
Mm-hmm.
sometimes they want to use a 14% personal line of credit to start chunking at their 2-3% mortgage. And I'm like, especially if they're already like 5 to 10 years in on that mortgage,
Right. Right.
it's like really unattractive. So I'm like, hey, instead of that, why not get the HELOC, at
Mm-hmm.
like an intro rate of between like 3 and 6% out the gate, and then maybe it goes to prime minus one, prime minus zero point
Right.
0.5, which ends up being like maybe 7, 7.5, as opposed to 10 double digits. And then in general, typically if I'm dealing with a double digit rate, I avoid, right? So I just try to
Mm-hmm.
avoid that with a lot of clients in that
Right.
particular case. So that's about as far as I go in terms of stressing on the rate versus rate. Where you talked about interest costs was referring to time and balance, which I think is really important because there is a world where yes, the interest rate could be higher than what debt we're trying to eliminate. But if we were to look at, well, how long are we going to be at that high rate
Mm-hmm.
compared to the extra payments?
Right.
And I think where people do incorrect math is, let's say someone's got a cash flow of $1,500 a month, so that's what, 18,000 a year. So then they say, okay, if I make 18,000 in extra payments, they put that on the Excel, and they do the same thing for 18,000, say lump sum or chunk payment is what I typically is the language I'm using on my channel, right? So a lump
Mm-hmm.
sum or a chunk payment of 18 grand, and they assume that it's the same 12-month timeline.
Right.
And so when they run that and they go side by side and they look at two Excel spreadsheets or whatever, and they're like, dude, the math ain't mathin'. And then I let them know, well, yeah, I agree with you. I totally agree. It does not make sense to make a lump sum of 18 grand at this higher interest rate when you could have just made those same 18 grand payments over a 12-month
Mm-hmm.
period of time. But what we have to look at is, well, how long does it take me to actually remove that 18 grand in this higher interest rate line of credit when you factor in income expenses, credit card usage,
Right.
like what is the time cost of money? What is the actual
Mm-hmm.
cost of money over what the rate is, right?
Right.
And I think often that's where the disconnect occurs, where I'm like, hey, it's not the same timeline typically.
Mm-hmm.
Plus,
Mm-hmm.
your spreadsheet is not honestly showing the impact of those extra payments in terms of when they actually hit the mortgage. Mortgages are really old school, right? Like
Right.
whenever I like ask questions, try to get the client's amortization schedule or like the login portal, it's very archaic looking, like old. It takes a while to like get information. And when you go to actually make a payment to your mortgage, depending on what day, what time you make that payment, it may not actually hit the
Right.
balance for what the Excel is showing, right? Because if you show an extra payment on your Excel, it immediately
Mhm.
shows the impact, right?
Right.
But if we're at the end of a particular month, because that's typically when most people have cash flows at the end of a month, and you
Mhm.
already are in the new statement cycle of your mortgage, you have to
Right.
understand that until you make your next mortgage payment, they might hold that extra payment
Right.
because your mortgage payment has to get satisfied first.
Right.
Typically, I would say, and correct me if I'm wrong here, but your mortgage payment has to get satisfied first before you make an extra payment,
Right.
right?
Yeah,
So if that's the
most mortgage contracts are done that way. There's a priority of what satisfies first. It's like a container, right? It's like, okay, this like we're gonna first put in this bucket first, and then this bucket then gets filled. So they always fill the interest or any fees bucket, right? They always have to cover their butt. The banks always have to, if there's any outstanding fees, late fees, even if you have made the payment, whatever payment amount, what they do is they take a chunk of that and satisfy any late fees, extra, whatever fees, and then they'll cover the interest, and then they'll principal, right? So it's funny, again, I'm not saying the banks are inherently evil, but they're a business. I get it. They have to make money to
Mhm.
thrive. So again, it didn't cut you off, meant to cut you off there, but that's a very important point, right? Is
Yeah.
it matters in terms of sequencing.
Right, because in this world that we operate in,
Right.
every second counts, so to speak, or like
Right.
every day counts
Right.
when we're looking at average daily balance. So, you know,
Right.
most of people's calculations on Excels aren't doing enough justice to the strategy itself. And typically, I'm
Mhm.
always like underplaying velocity banking to prove a point, right? So I'm always
Right.
like making the results look worse than what they are. And quite often, I'm still coming out up ahead of these extra payments. Still, when you look at when you make that extra payment, especially between the cycle you're in and the next statement cycle, that
Mhm.
extra $1,500 payment won't get registered until your actual mortgage payment is paid. So let's
Right.
say that's another 7, 8 days. And you have to understand the way amortization works.
Right.
It's a pre-scheduled timeline, right? Amortization is a form of payment, right? It's already laid out. And the only way to affect it is by paying the payment first and then adding more principal before
Right.
the statement cycle ends, right? to
Right.
to to make sure that next mortgage payment you're going to see the impact of less interest being charged on the next payments, right? So it's
Right.
almost like a month or two delay, I would say, in my opinion, of you making extra payments versus if you made that $18,000 extra payment on January
Mhm.
1st at the top of the year.
Right.
That alone is going to impact what 18,000 over 12 months will do. That alone is a difference. But then now we
Right.
have to
And
look at our cost of money to do
right.
that in the home equity line of credit. And I think that's where the difference occurs, right?
Right. And
That
that 18,000, right, that you're doing as far as quote unquote extra payment principal into the mortgage is also is accelerating the amortization. So subsequent payments after that on your amortization payment, um, more of it is now actually going towards principal. So your payments every month is now more efficient than pre-January in your scenario. So yeah, no, excellent point. I would agree 100% on that.
Yeah. So that's what I've heard so far. And then you also brought up that rates could be coming down. And correct me if I'm wrong on this, but when it comes to when the Fed announces a rate, immediately as it relates to home equity lines of credits, I don't know
Mhm.
about credit cards or PLOCs. I've typically have seen PLOCs stay the same. So I have
Mhm.
clients that have a PLOC still today at like 7, 8, 9% versus
Mhm.
people who would go and get a PLOC today might be in the double digits, right?
Mhm.
So I often see that a personal line of credit unsecured will typically hold its rate year over year.
Mhm.
I don't know if this is like fully accurate across all the board, but
Sure.
when I look at these smaller banks, I typically see that. I'm like, that's interesting, versus my clients who have second position HELOCs, first position HELOCs that are variable rate. It changes month to month. So,
What I find to be true with that, and sorry to cut you off
no, you're good.
again, Denzel.
Mhm.
By the way, just give me that full permission if you need to. But no, in all seriousness, what I find to be true, and I this is just my speculation. I have no data or evidence to back this up. What I find to be true is that PLOC is not. Let me give you the technical term. A personal line of credit, a PLOC, is a portfolio loan. The bank doesn't trade it. They don't sell the PLOC. They
Okay.
don't. So what the banks do with most HELOCs, or at least first lien position, from what I know, is they'll lend you the first lien position HELOC and oftentimes sell the paper, so sell the debt on the actual HELOC over to a secondary market. They sell it to other bond investors. They sell it to Wall Street. They sell it to certain hedge fund companies that buy these types of loans because they are very lucrative. Second lien positions and PLOCs, not so much, but PLOCs specifically, I find that PLOCs are more so a customer retention tool for banks. They don't make money on PLOCs. They don't really particularly have a reason to give out PLOCs for a profit center. It really is kind of a loss leader for most banks, because the
Wow.
psychology there is, if they can give you a PLOC, and let's say they give you a $10,000 PLOC, the likelihood of you switching to another bank is not going to be high, because with the personal line of credit, say with a XYZ bank, you're going to have to get a checking account to even turn it into cash. I mean, yes, you can go to the teller and say, hey, I want to write a check out of my personal line of credit without a checking account, but it's super duper inconvenient to do it that way. It
Mhm.
is convenient to have a checking account and a personal line of credit in the same institution,
Mhm.
right? And make those online transfers back and forth near instant. So most banks use a PLOC as a customer retention tool or a customer acquisition tool, because they can say, hey, come to our bank, we'll give you $25,000 personal line of credit, but right, to get the money out, you're going to have to open a checking account.
Mhm.
It's a great retention tool for the banks, as a business model. So I think the reason why you may have observed interest rates staying relatively the same for personal line of credit is because of that reason. Is, hey, we want to keep you as a customer. We don't want you to go shopping around. We want to keep your deposits, or we want you to come and deposit your money with us, because that's how the banks ultimately make their money. So yeah, it's an interesting observation, right?
Yeah.
It's doesn't necessarily help with accelerated banking strategy, but it gives you the psychology and at least behind the curtain, look as far as what the banks are doing.
Gotcha. Yeah. So I like that. And so, what are some other things that, so we covered interest rates potentially going down, right? And how
Mhm.
that immediately has an effect on HELOCs. We can immediately see the difference, right? Whereas
Mhm.
if I'm already a individual family man that has a home and you already have your mortgage locked in, right? Not talking about those who have your 2, 3% mortgages from
Right.
2021, 2022, but those who got mortgages this year and last year that are at 6, 7, maybe even 8%, right? Um, you don't get to participate in interest rates going down unless you what? Refinance, right?
Right.
So for me, a huge update that I'm seeing, and I think this happened years back when rates were going down, velocity banking picked up a ton of speed during COVID
Right.
because everybody was locking in 3.5% first lien position home equity lines of credits or second lien HELOCs for like a year or
Mhm.
fixed rates for 4 or 5%. And it was like really awesome. And those of you who
Mhm.
are in the chat now, if you're one of those people that obtained a first or second position HELOC at the beginning of COVID and then about a year in to COVID, comment below what your experience has been over the years. And then everyone else, that conversation of rate versus rate started to become more of a concern for the average customer getting into this space. But now people who got mortgages and are discovering this concept for the first time, would you say that they're like at a really, really good time to be practicing this particular strategy because of rates potentially coming down? Would you say
Right.
that?
Yeah. I mean, what an awesome opportunity. I know there's going to be like what you're referring to is a lot of instances of people considering refinancing for sure. Absolutely. Um, Obviously, you might look at this and go, well, instead of refinancing, might as well go to a first lien position HELOC, right?
Mhm.
If I were already at 7%, and let's say a first lien HELOC is being offered at 6 or 6.5, great, awesome, right? The benchmark cost of where you have been, which would have been like ludicrous, right? Obviously, you are going to save, or you're going to potentially save a lot of money based on your cash flow and projections. So, yeah, it's a great opportunity. I think first thing HELOCs kind of were put in the sidelines over the last 12 to 18 months because it just didn't make sense to
Yeah.
hold a high balance at a higher interest rate for that long. And in those instances, I was encouraging people not to do the first lien HELOC as much as I love the product. And secondly, HELOC and PLOCs were making more sense at the time.
Yeah.
But now we may see a switch. We might actually see the opposite, where first lien HELOCs for those individuals that had 7 or 8%, fantastic. Given that you are going to have the cash flow, your DTI is going to look great, your debt to income ratio. So yeah, I think it's going to be a very exciting opportunity. If you are going to refinance, obviously consider accelerated banking, velocity banking. Yeah, it's gonna be very interesting, Denzel. A lot of refinances for sure. We'll see in the next, 6 to 12 months. Is it gonna be 2020, 2020 again? No, I don't think so.
Not that.
Yeah, it's not going to be that crazy because 2020 was crazy.
Mhm.
But nevertheless, I think there's still an opportunity.
I got you. So the other thing that I enjoy about the space that we're in, for the most part, content creators like us that are touching on these strategies, is we're not specifically loyal to any specific banking product, which
Right.
whatever makes sense for that particular scenario is what we're going to, educate the client on. So for example, if first position HELOCs are just unattractive compared to a second position HELOC, no closing costs, an intro rate for about a year
Right.
at like 3, 4, 5, 6%, and then it goes to prime minus, um, and that individual can control a $50,000 HELOC, making smaller chunks over the same period of time to their mortgage, could be way
Mm-hmm.
more impactful than someone that just refinances their whole entire first lien 2, 3, 4% mortgage into a 6, 7, right?
Right.
And that, plus there's closing costs, and it takes
Right.
like 2 months for it to like close, and there's a whole lot of work involved. And sometimes the bank might
Mhm.
might want the client to pay off some other consumer debts to meet their DTI
Right.
requirements. So it's like all these different things where we may not see that with a second lien HELOC. So I like that you're also more than willing to say, hey, this doesn't make sense to use the first lien HELOC in this context, in this scenario. And I think that's
Mhm.
super important for us to continue to put out more content, because I do believe you've got a lot of smaller YouTube channels that have risen over the years due to your rise, mine, Christy Van's, and a few
Mhm.
others that have been honestly benefiting in terms of viewership with the videos we had in 2020, right? Or
Right.
2021 or 2022. Those videos may not translate the same today. I've noticed that in some of my own content. And so I've put out material letting people know, hey, yeah, back then, notice what the rate was. And today, when you look at what it costs to refinance into a first lien HELOC, it's just not that attractive, right? And so
Right.
us looking at a second lien, potentially, or even a personal line of credit, right, or second lien in combination with credit cards, could be way more attractive. So I'm guessing you've had to put that out as well, educating folks.
Mhm.
And so now transitioning into I guess if there's anything else you want to add in terms of macroeconomic environment that affects velocity banking, accelerated banking in a positive, negative way, was there anything else you wanted to add or bring up?
No, I mean, not particular. I mean, I think we expressed, everything that needs to be said about what's coming at least in the next 6 months. Interest rates
Okay.
coming down, great opportunities are ahead. For both, those that are practicing velocity banking now and those who are going to or have been considering. Um, Here's another thought that I didn't mention is that those that were at least at the time not qualified for either a second lien position or a first lien, this could be the opportunity because when the interest rates drop,
Okay.
when the banks do a stress test on you, they may stress test in a different rate or a decreased rate. So for those that were just on that teetering border of like 40, 38% DTI, which obviously we would like to still see a better DTI percentage than that, still allows you to get you in and get started. And the obviously the goal and the hope is that we can help you decrease the DTI percentages. But for many of you who have kind of been on the sideline because you couldn't get qualified for a line of credit, this might be it. I mean, in the next 6 months, we're going to see a lot of people who weren't able to get a line of credit being able to do so, obviously with the motive and intentionality of having a budget, having a positive cash flow, obviously using the tool for the right reasons. Yeah, so that's a great opportunity that we're also seeing as well for the
Okay.
next 6 months.
Gotcha. So transitioning now to you and Daniel, your company, right? Accelerated banking. What are some of the things going on in-house that
Sure.
you feel is going to be a major impact and influence in terms of how people look at mortgages, period, and how we look at this strategy, what it does beyond just accelerating debt? I know there's conversations where I've had with clients where it's like, hey, here's a guaranteed way that we can not only accelerate our debt, but get a guaranteed cash flow recovery. And this is how much interest you will save. And this is the results. And this is the timeline. And then I'll run another scenario with them. We'll say, well, here's what it would look like if we did not pay off your mortgage
Mm.
and only paid off your other consumer debts, left the mortgage alone at that 2, 3%, 4% rate, and took the same amount of time it would take you to pay off this mortgage to invest, say using accelerated banking or build a policy or two in the household, and then have the option to
Hmm.
pay off your home with a check in full in the same amount of time or relatively close that it would have taken you to just become debt free, right?
Hmm.
Wondering if you have those kinds of conversations. All right, so I'm gonna have that kind of off to the side there, and then you can touch on first kind of what's going on in the company with you, different things that you're rolling out, different
Hmm.
ways of providing this helpful education that clients are asking themselves, people watching, does it make sense for me to pay off this 2, 3, 4% mortgage? Or if I'm at a 6, 7, 8% mortgage, does it make sense for me to accelerate this compared to if I would have just invested in the S&P 500, right?
Hmm.
Like, I think these are genuine questions, and I'll let you chime in on, in this space that we're in, do you often see content creators like us, maybe more often than not, promoting paying off the mortgage before anything, paying off all your debt before doing anything else, which kind of like somewhat aligns with Dave Ramsey theory, right? Get all your debt
Right.
paid, right? So it kind of aligns with that in a way, and then transitions to investing, or invest first, right? Does it, how do you figure out that kind of person you're talking to? What characteristics do you typically like
Sure.
to see for that person to say, for you to feel confident, you know what, yeah, go do that, go take a bet, go take a
Yeah.
risk, right, to make that happen? So
Yeah.
that's kind of over
So
here, and then what's going on in your company over here.
right. So yeah. So what I'm hearing from you, obviously, is what's going on. Company, what's exciting, what's happening the next 6 months from us specifically, and then obviously talking about okay, how do you weigh the conversation about should you invest versus should you pay off your mortgage. I do have different thoughts about that. And then I think the other thing you may have mentioned was how do you deal with certain people with different propensities, right? Um, so the first thing I'll tackle is what we are doing. I mean, I can't share too much because certain things are quote unquote,
Little sneak peek, little,
even for me, right? It's classified, right? That we can't necessarily share until when it does happen. Otherwise, I'm going to get the scolding from my team. But but what I can share, and this is something that I actually kind of been wanting to do for a while, and this is something that I actually even talked to Denzel about just briefly, is the idea of, and I don't care what we call it, it doesn't have to be this name, but something like an accelerated banking institute. It's an inter leadership. It's not about one company over other company. It's not that competition. It's not about that. It's about how do we set standards that are very clear in the industry that we're all kind of consistent in what we're saying. Because I do see content creators, and I'm not going to point out names. It's not the appropriate, platform to do that. But I do see content creators, best of intentions. Yet I hear them talk about velocity banking, accelerator banking, and I'm like, oh no, I wouldn't have said that, or making absolute statements that obviously cannot be backed up or followed up, or things that velocity banking, accelerator banking just does not do or does not promise. There are things that are said that obviously will garner attention, but for the wrong reasons. So I have this vision of seeing something like an accelerator banking institute or velocity banking institute, cash flow management institute, whatever you want to call it, where individuals like myself, Denzel, and other practitioner content creators, those that genuinely are in the space of financial education, to come together and have healthy conversation, discourse, as well as, hey, what is actually working right now in the market? What is actually helping people? And what's hurting people that we could absolutely bring awareness to the consumers and the clients out there to stay away from. Because I think it's the inconsistency of messaging and what the consumers are hearing. It causes confusion. And there's a good case study on this, and that's the credit repair industry. 20 years ago, when the rise of credit repair industry came about, the regulators didn't really care all that much. But it was not until 15 years ago or so where a lot of credit repair companies took advantage of clients, customers, got paid but didn't deliver services, promised to increase credit score when obviously there's no real mechanism to do that. Made all kinds of false advertising and false claims and misrepresentation. And that's when the regulators stepped in, to the point where in state of Georgia, credit repair organizations are illegal. You can't do credit repair organizations. Yeah. And well, one can argue that it was Equifax that did that, but because Equifax is in Georgia, right? So, right, it makes sense. But there are, that's why the new rule, relatively newer, I should say, rule like the Credit Repair Organization Act came about, where it started to regulate organizations that do credit repair or do anything remotely close to credit repair, such as you can't prepay or you can't ask a client to pay upfront for a credit repair, right? It has to be done after the repair has been completed. You can't make any promises. They have to make disclosures that individuals, clients, consumers can do their own credit repair. They don't need to have a credit repair company, which is true, right? Those are all factual statements. And so it's just unnecessary things that came about that if the credit repair companies would have acted in with ethics and moral, that didn't have to happen. It could have been a respectable industry. Now I can't say that. I can't say the same. I mean, there are a lot of crooked people in the credit repair organization.
Yep.
Versus, and there are good people too. And part of my fear, and if I'm truth telling from my heart, is that the fear that I have is that velocity banking and accelerated banking is kind of headed in the same direction. Correct. Is that if the wrong things are said, if false promises are made, if there are misrepresentation happening, then yeah, similar things are going to happen where, yes, enough people are going to get hurt, and those people are going to cause the legislation to change hopefully for the better, right? Obviously to clean up what's going on. Um, and so, yeah, we just, all of us have to be careful. We have to be ethical, moral. We have to do the right thing, even though, yes, it means that, who knows, it might be less client for some people out there, but we just got to be honest. And I stand by that. And
Yeah.
I actually, in a private text message, I told Denzel, "Hey, you're the guy. You should head this up because you're so passionate about this." And so, yeah, I think that is something that we would like to see happen.
Mhm.
Inter-organization come together. Let's talk about this beautiful thing, strategy, and we just want to standardize what's factual and what's not. So that is something that we would love to see come true and to come to fruition in 2025 and beyond. So that's something that, my company, if we were asked to be part of that, yeah, heck yeah, we'll be more than happy to advocate for something like that. So I know I said a lot, Denzel. So I don't know if you had thoughts
Mhm.
about that
I
before I
do.
shared forward.
Yeah,
Yeah.
I'm gonna take it to the whiteboard here. So three things came up in my head. We've got the potential of you rolling out some sort of an institute very similar to, like, say, like the Nelson Nash Institute, or the Dave Ramsey certification program for financial coaches, or like the Nelson Nash Institute for registered licensed life insurance agents. In the velocity banking space, or accelerated banking, paycheck parking, mortgage acceleration, there's only about four marketing terms out there that I've heard of. It's paycheck parking, mortgage acceleration, accelerated banking, and velocity banking. So very few marketing terms to represent this
Mhm.
strategy. And there is no certification required to talk about this
Right.
particular strategy. There's no regulation, there's no oversight, and in a way it's a kind of a beautiful thing
Hmm.
when used properly, and if abused can be a terrible thing.
Right.
So one of the two things that come up for me is ethical marketing and misrepresentation. And the misrepresentation occurs in the marketing. So basically, how you and I put our titles out, I've always been very, very just more aware, and I know in my case it's cost me more views, right? Because if I were to say things like velocity banking equals financial freedom, right? Or here's how velocity banking
Right.
can dramatically change your life, and why velocity banking is always better than extra payments. And so when you see these radical titles that I or you, we could easily, use that and ride that wagon of marketing. And
Right.
in a way, it's genius. It's like genius marketing to obviously attract eyeballs, to say something bold and just out there. And then you watch the videos, you think that's what can be done. Then
Right.
the client goes, or I should say the viewer, not necessarily a client, but the viewer goes and tries and does it, try to do it, and get a completely different result. Now, the other thing is sort of, comes with, I want to say this really falls on the viewer, is a viewer watching a video 9 years old. And
Right.
that's an economic environment 9 years ago, nothing compared to what's today, what's going on today with inflation and higher interest rates. So it doesn't apply that particular
Hmm.
scenario or case study. And so that part, I think, falls on the viewer to be mindful of what you're watching and to evaluate and compare. There are certainly principles in that video 9 years ago that can be applied still today,
Right.
right? But the whole idea of, let's say, getting a first lien HELOC, just switching for the sake of switching, for the sake of doing the strategy, for the sake of just doing the strategy. I've encountered a lot of viewers, unfortunately, that become clients that say, "Well, I was informed to get this first position HELOC, and I
No.
had a 4%, 4.5 mortgage that I was already 7 years in on, and now I'm wasn't taught how to actually use the thing. And so the ethical marketing part, the misrepresentation, where your institute, I believe, could come into play, is really reaching out to these content creators. And the fact that you are one of the top, I think, would provide that initial interaction, at least to get that dialogue from other content creators. And I think the other cool part, if we get ahead of this now, you and I together, and some of the other content creators watching, if we could band together, disagree on certain things, right? We're not going to agree 100%, but if we
Right.
can get, as you said, some principle, factual things down as it relates to this strategy, not only is it going to benefit the people watching, but I would argue that the next stage for accelerated banking, velocity banking, is developing partnerships with banks to actually write
Mhm.
product. And I mean, that's how this product came to be. Is we go all the way back to Australia. They have certain products in Australia that don't exist here. They have something called offset accounts, and we don't have that here. But the closest thing to that is a home equity line of credit, what they have
Right.
over there. And so being able to like have that credibility, legitimacy, reputation, the thousands of people you've helped and served, the thousand-ish people that I've been able to help and serve, and others kind of coming together, like, look, the the pro of what we've been able to do all together compared to the amount of people that have been hurt, not to negate, not to decrease that. Yes, people do get hurt when they do this strategy because they were misinformed, right? Or they
Right.
were marketed something that didn't actually, end up occurring. And there's honestly no regulation around it because you are doing this at your own free will. To no one's twisting you by the arm, putting a gun to your head to go get a first lien HELOC, right? It's
Right.
just very, very persuasive words that are being used to get you to go
Correct.
get those tools, right?
Yeah, yeah, we
So
yeah. So we're coming to a time where, and again, no one is doing this that I know, but those that are advocating velocity banking and accelerator banking, but we need to rely less on snake oil salesman marketing tactic, which again, no, I know no one's using it, but it has the potential to be. That we need to band together to build credibility, and also acknowledge that no one owns velocity banking, no one owns accelerator banking.
right, it's
It
just
just is, and
mhm,
most concepts or most things die because of either trying to control or trying to take over some certain things. I'm on the opposite. I think you got to let it live beyond just one organization, and free it to people to access. So one of the things that we're spending a lot of resources on right now is really cleaning up our own marketing too, right? If we're going to ask other content creators to do the same, we have to do it.
yeah,
So we actually ended up hiring a rather very expensive attorney who's well known in marketing compliance, and you may have seen his ads before, but yeah, engaged with him, and he's helping us clean up a lot of our marketing, backing claims, substantiating claims, which are all important things for the longevity of not only my company but also the strategy itself,
yeah,
so that everyone else can also promote and use and take good in it. So
mhm,
um, yeah, it definitely is something that we would like to see come to fruition. The banding together, the togetherness of the content creators and the different experts in the space.
absolutely. One thing that I think we could all band together, a fact that I myself didn't know what I didn't know years ago, is the whole amortization versus simple interest sort of debate.
Yeah.
When I first heard someone else say it, my interpretation and theirs was that amortization interest is one thing and simple interest is another thing. Two different
Hmm.
forms of interest. And I sort
Right.
of went with that definition because, and this is what's tough, is if you Google what is simple interest and then what is amortization, it's like you do get two different definitions. And then when you are talking to the banks, there is a amortization loan and then there is a simple interest loan. And so it's like, well, it sounds like they're two different things. And so for years, I went with that. And then until I started having conversations with some other content creators, such as I'll shout out Christian, who's a content creator that is actually not for velocity banking, doesn't agree with it. But one thing that we were able to come in agreement with is just understanding how interest works. And this particular person has been in the mortgage space for I think like 20 plus years. And I was able to talk to a couple other guys to kind of verify. And the final conclusion I came to was that amortization is a form of payment, right?
Correct.
It's not a different interest altogether, right? So
Right.
that's like a half truth, right? You can say that the form of payment on that amortization loan has the potential, right? Or honestly, the fact is there because it shows you the entire amortization schedule that
Right.
you will pay, say, 2.5 times, right? Or almost 3 times what the original balance was, versus if you had a simple interest revolving line of credit that
Mm.
remained that remained a simple interest revolving line of credit for the same period of time, would actually get paid off sooner because of
Mm-hmm.
how the interest gets applied, daily
Mm-hmm.
versus preset. And
Mm-hmm.
so that is one of the things that I believe we all could clean up, getting your help and me. I even had to go back and I have a playlist literally on my YouTube channel.
Yeah.
Literally, I want to say it's titled My Worst Most Watched Videos. And all of them, my most viewed videos, a lot of them have small errors in them, right? Or I
Mm-hmm.
said something that was incorrect or not quite correct or a half truth. And then I
Yeah.
would comment below and say, look, this is what this is, or I made a mistake here and I'm improving. And then I'll make videos saying, I've got videos out there that says velocity banking mistakes I've made over the years and what my new, look on it now is, and just understanding that amortization interest, simple interest, it's the same thing. The difference is the form of payment. How is the interest being applied to that? And
Right.
that's where we get the difference. So I would say
Yeah.
that's one thing, that whole amortization versus simple interest.
Mhm.
Misrepresentation. I think that occurs a lot on TikTok and in short clip videos. Those
Yes.
out there that are putting out long form content where they're like showing the entire thing and breaking down the math, um, that's where you see, say, less or almost no misrepresentation occurring there. But in the short clips where I see velocity banking and accelerated banking being misrepresented is when we talk about credit cards, right?
Yeah.
Specifically, is you will often see these short clips of people saying how they use their American Express card, their Capital One, their big bank credit cards. And I'm like, why are you doing that? And they'll say things
Mhm.
like, 25% is not really 25%, that I can, cut that. It's, divide into 12. And yes, there's some truth to that in terms of what they're saying. But when you look at what they could have done with, say, a personal line of
Mhm.
credit or home equity line of credit, we could get way better results. And I think um, the attraction with credit cards is almost anybody can get a credit card today, right? Even
Right.
with low to bad credit, almost anyone can get a credit card,
Right.
and it's a great tool to rebuild credit, get your credit up, and I may use that to get someone to graduate from a credit card. I'll have them graduate to a PLOC, and then when there's enough equity in their home, they graduate to a HELOC. So I'm like, it's a graduation process. This is not something we stay with for the duration of the strategy. We want to be able to improve and build along the way. But when we say things like pulling, uh, like doing balance transfers or even cash advances to accelerate a
Right.
debt, and then you stick it in the card, and when they say things like run all their income into the credit card, I'm like, you're not able to run all your income into the credit card. And if you are, you're paying extra dollars to do that for the
Mhm.
bills that cannot be paid with a credit card. or
Correct.
or you can say yes, it can be paid with a credit card, but it comes with a processing fee, right? Or it comes
Mhm.
with a cash advance fee. to get that
Right.
bill paid. And so all you did was increase your cost of living in that regard.
Right.
So I'd say that that happens a lot. And so with this institute, what are some ideas you have in terms of like targeting the people who are out there, like myself and others that are you know trying to do the best, help people, right? Have good intentions, but maybe saying some incorrect things. And you've even you put yourself in the hot seat. You even said, look, we've got some stuff that we're cleaning up. And I put myself in the
Right.
hot seat. I've told my clients, I'm like, I'm gonna make a mistake. I'm human. I'm gonna
Hmm.
like say a number wrong, or you
Right.
know, misrepresent this in this particular case. But the principles stay the same. I'm like, when you know the principles and you know how the math works, you can verify the teacher, right? And not just
Hmm.
rely on the teacher. And I think that's where people get into some future problems, right?
Right.
So yeah,
Yeah.
any other like thoughts of like, okay, putting people through some sort of certification, or is it more of like a place to gather and dialogue and then put out content in a way?
Yeah, yeah. I think the latter is probably more closer to what I imagine because when you start to certify people, you're I mean, it's a good idea, but it gets dicey because well, who profits from that, who benefits, right,
Right.
etc.
Then it
Um,
becomes a hierarchy. I'm
right,
better than
exactly,
thou
right.
because I have a certification and you don't. And so
Right.
that's what we're
What I
talking
can
about.
see though happening is providing genuine value for both consumers and practitioners. And here's what I mean by that. I imagine with this institute, and there'll be a voluntary thing. If you want to join, great. If not, you're on your own kind of thing. But I would love to see different companies that advocate accelerator banking, velocity banking come together, set aside any competitive, what's the word? Animosity, right? And come together, just have a dialogue. I mean, we don't have to share our secrets about marketing and advertising, but let's talk about what we're actually teaching the product because velocity banking, whether you learn it from Denzel versus me, there shouldn't be a whole lot of principal variance. It should not be because math is math, right? And the fact that Denzel and I aren't like calling each other every day, right? We're good friends, but we're not like married, right?
Huh.
We stay good friends, and I've met Denzel and Allison a couple times just in person. But the fact that every time we come together and to chat, that we come to a similar conclusion about the math and the principle of velocity banking tells me, okay, math is math. It's not one times one is not different in Florida versus Illinois, right? It's
Mhm.
the exact same. So just coming together and principally being in agreement, I think is one big thing. I also would like to see some of the best academics and finance professional, independent of velocity banking, to come and actually verify what we're saying is to be true. I would like to see math professors, actuary professors, economic professors to come and validate and verify what we're doing to be accurate and true, and call us out on things that are not true. We'll take it, right? We will love to, and just have this interdisciplinary community of business, the best minds and academics, the best thinkers in finance to come together and just
Yeah.
talk about what velocity banking out to be,
Almost
and
like
then
a
just
think tank.
having a yeah, exactly, and have a unified published statements about here's what it is, here's what's not. I think another genuine value that this institute or this group can provide, perhaps, is obviously ongoing, workshops, teachings of velocity banking, like content that we can create together, like what we're doing now. And but also, if we're talking about if there's a commercialization of this process, I'm not going to hide it, and neither Denzel will. But yes, I do make money teaching velocity banking and accelerator banking.
Right.
I have a program. I have software services that I offer.
Mhm.
I'm not shy about sharing that. But also, that comes with inherent risk. So, what if we had an institute that also provided some kind of a insurance or some kind of a institutional backing for different content creators to say, hey, and as long as you stay within or ensure that you are saying the right things in terms of what velocity banking is, we will back you up for your commercialization
Uh,
of the concept.
Almost
You
like
know,
E&O insurance, right? Errors and omission,
correct.
right?
Right.
Something like that.
Exactly.
Okay.
So
I love
So that way there is actual value of, okay, if I, am part of this, it's part of like an association, right?
it. Yeah.
So yeah, so just strengthening the industry through banding together, right? I think
Mhm.
is kind of the next big move for the concept and the strategy and the people. And I think by doing that, could seriously attract the right people to take a look at this and go, yeah, this is legit, and it out to be talked about more than just put it as a sideline as a YouTube strategy.
Right.
Yeah, I think that's probably what'll give more credence to what we're doing.
I think that's wonderful. The idea of getting independent sources to come in and verify us would be amazing. I've never seen that done in this particular space. What I have seen, and it as a viewer, as a free thinker, when you see those who are against velocity banking that have YouTube channels, why are they all mortgage loan brokers? Like all of them
Right,
that I've
right,
seen, that these other YouTube channels that have podcasts, they're putting out videos, and all of a sudden, since 2020 and up until the last 4 years or so, they have been writing that marketing term, velocity banking. And that's the only term I've seen them use. Velocity banking is a scam. And
right,
then they're like, buy my mortgage loan instead. So I'm like, well, that's interesting, right? Like, let's just say I don't even
right.
like velocity banking. Let's just say I'm not going to do it, but we're using, say, this strategy to get you to buy or go into debt in a different form, which is an old way of acquiring a mortgage, right? It's just
Mhm.
that's always been interesting to me to see that, and so I think what would be even cooler, and I would actually respect it a hell of a lot more when someone does have a following and they're an influencer and they're completely independent of any benefit of getting people into debt or out of debt, and they're just a
Right.
math professor, they're they're a math engineer, like they're just like in a totally different field. They're like, they came in, they looked at this and they were like, no, this looks crazy, here's why. I respect the
Yeah.
heck out of that person, and then
Oh,
I
yeah.
can, I feel like I could have a deeper discussion with them and say, well, what about this, and then what
Mhm.
about that, and they're like, oh, I see how in that case, yes. And then the arguments typically fall on the psychology of the user. Has nothing to do with the
Correct.
math. It's usually the psychology of the user. What is the likelihood of this person actually having success with velocity banking? It requires 10 more additional steps than just extra payments. And for that, I totally agree with them as well. I'm like, yeah. And
Yeah.
if you are a person of discipline and character, and you are a good steward of money, and you understand how math works and how these products work and the risk and the leverage capacity, I'm game.
Mhm.
And that's kind of like
Yeah.
how I've
That
been. Like,
that's
what's like, for
exactly
me,
it.
it's nothing.
Yeah, that's exactly it, right? Again, I think both what Danzo and I can agree on is velocity banking, solar banking is not for everybody. It's not a magic pill. It's not some, surgery, financial surgery, right? To
Hmm.
get things, your financial problems go away. It is for, like you said, for certain individuals that have the basic disciplines of budgeting. They have positive cash flow. They understand, that they can't just frivolously spend money, go to Vegas trips all the time. It is for those individuals, right? And so there's nothing inherently wrong with math. The other comment I would say is with people who are staunchly against velocity banking, because A, they don't understand the concept fully, or when they attempt to explain it, and I'm like, oh, yep, you missed a step, right? The other aspect to this is they have some kind of personal vendetta against a person or organization. I've seen another scenario where they're a financial planner, where I actually seen some financial planners come around and say, "Hey, actually, I can add this to my practice. This is great." But I also seen certain financial planners that are in love, or they romanticize about a specific financial product, that they see this as a threat, right? And therefore they make, obviously negative comments about it. Um, but yeah, so I share the same observation as well, which I kind of thought was interesting. I'm like, so you're saying we're a scam, but you're not, but what? Like, you're telling people to go get a mortgage? Like, that just defeated your credibility right there. I mean, it just, yeah, it's silly, but yeah.
Right. So one more additional thing that came to mind. I want to get into the the questions here. Just to recap here. So we've covered a lot on the what's going on macroeconomic environment, how
Mhm.
interest rates coming down can actually benefit velocity banking users currently who have variable rate HELOCs and those just getting into the concept that maybe weren't qualified before. And with the new DTI formula and how they run the monthly minimum payment on that new debt might get them to where they need to be if the rate is slightly less, things like that.
Mhm.
We went into the accelerated banking institute that you want to be able to launch, and I definitely want to volunteer and I want to help and I want to serve to help in the area of ethical marketing practices, reduction of misrepresentation, and then releasing or letting go of certain ways of thinking. For example, the amortization interest versus simple interest. I think that's not an argument that we velocity banking practitioners even really need to use to make our point true, right? So I think we could totally
Correct.
like you could totally let go of that. That's something I use for a couple of years, and then I just haven't because I was like, oh, I don't need that to prove my point. I can just show the
Right.
math, right? I can just
Mhm.
let that be the thing. And I also this when I release that, getting to my next point here is now that I've released the whole amortization interest debate, I'm no longer looking at mortgages as some evil product that the bank decided to
Mhm.
create and there's some conspiracy to like keep people in bondage. And I understand that mortgage means death pledge. And so there's like different ways of thinking where it's like I totally bought into that for a little while. I was like,
Mhm.
yeah, and I would talk to clients. I was like, well, your mortgage is a death pledge, right? That's what it means. Root word of mortgage, right? Da, da, da. And I would break it down and I'm like, look, like, you're going to be stuck in this thing forever. And here's a way to get out of it and use the same tool against the banks, right?
Mhm.
This is the bank. The banks don't want you to know about this product because it actually helps you more than it helps them. And it's like,
Mhm.
once I got rid of all that, it removes another stain, I think, in this particular space is we tend,
Right.
and I'm putting myself in the hot seat here, is like
Sure.
we or I tend to look like more radical right leaning individuals
Well,
that think
financial
banks
people
are
hat, right?
right, like the the major banks are evil, and here's why
Right.
you need to do this. And there's a particular organization out there where I learned it from, and I believe you learned it from as well. And that's kind of
Right.
where this all kind of stemmed out of. And I
Yeah.
noticed that those who left that organization, like yourself, like myself, like Mike Adams, right, and others that left this particular organization, they started to have their own way of thinking about it, and we're
Mhm.
like, oh, like, yeah, this is, I'm not against a 30-year mortgage. I think there's scenarios where it totally makes sense, and then there's
Right. Right.
scenarios where, a first lien HELOC makes sense, and there's scenarios where it makes sense for me to pay off my debt faster, and there's scenarios where it makes sense for me to maybe go all in on myself on value creation over the next 5 to 7 years, and then I can just stroke a check to pay off all my debt in full in
Mhm.
the same amount of time it would have took me to exert all my extra cash flow every single month
Mhm.
toward debt elimination. Granted, I'm a good steward, good discipline that I'll actually do that and not get into more debt along the way. Right.
Yeah.
So, anything you want to add there before I just kind of touch on some questions? I also want to be mindful of your time. We're a little bit past an hour. I just want to be mindful how much more time you got
Yeah.
left.
No, I think this has been a really good conversation.
Oh yeah.
I think one that needed to be had, and I think this is a step towards the right direction of not just my own selfish, ambition, but like just what's good for the industry, what's good. And I study different industries that have either thrived and gone beyond, the peculiarness, and or the concepts that are just kind of died away or being labeled as, oh, it's a kind of a kind of a scummy type of
And pyramid. Yeah.
concept.
Hmm.
Yeah, and so yeah, I think this is a great conversation, step towards the right direction as far as where we need to go, what we need to be doing, to set aside our ego and to really come together and band together to talk and just have conversations about what's true. Um, so yeah, I think this has been great, Denzel, and I think I'd love to do more of these for sure. Hopefully, the next time we do it, we'll be in the context of Velocity Banking, Accelerated Banking Institution. Um, the other thing, just to add and throw out there is, um, I can see the institute also pulling money together to afford the best attorneys, to afford the best legal, war chest, to really buy help in terms of, okay, discerning what is good marketing, what's bad marketing, what can we say, and what we shouldn't say that could potentially leave a bad or negative impression or inaccurate impression with a consumer watching any of our videos or marketing. So yeah, I think this has been great. Love to take on questions and
Okay.
yeah, get some answers out there.
Definitely awesome. So from Jay here, it says, "Good morning. My question pertains to being able to use accelerated banking slash velocity banking to implement infinite banking. I have a balance on my HELOC that is large enough to prolong my IBC journey by 5 years, which makes me nervous waiting too long." So this is, I want to say, a slippery slope in my opinion.
Hmm.
And this is something that I want to say I started talking about it maybe in 2020 and 2021 a little bit more, which is the idea, and I think I probably even much sooner than that. I haven't heard anyone in the infinite banking space, Nelson Nash Institute specifically, Become Your Own Banker, Bank on Yourself, Caleb, none of those guys, Garrett Gunderson, I've heard none of them ever talk about the idea of borrowing from a line of credit, a portion or all, to
Hmm.
help an individual max fund a life insurance policy, borrow against that, throw it back in the HELOC, make an investment or do something to
Hmm.
that effect. Or if it's just a matter of borrow from the HELOC to help max fund a policy, borrow from the policy to make an investment, buy real estate, do velocity banking on your HELOC
Hmm.
in 12 months or less to bring it to zero, to do it again, to max fund your policy, to borrow, to make the investment. So now your borrowed dollars are earning interest. You then borrowed from that debt a second time. So money got used
Hmm.
once to fund it, second to borrow, third to fund an investment, which is now earning interest and cash flow, let's say. And then you're doing velocity banking over here with all your income and cash flow, maybe the cash flow from that investment.
Hmm.
And it's, radically paying down the line of credit to get your policy max funded again. That's a slippery slope. Not even going to be, I'm
Right.
not going to pretend
Most
like,
people should not. Yeah.
I bet like for the 44 people watching, it just went like that. And
Right.
maybe,
It's a
maybe
very advanced
1%,
strategy.
maybe 1% were like, I love it. I'm pretty sure
Yeah.
J10's like, I love it. And those people
Right.
I know I can like have some
Right.
fun with. And I'm like, yeah, 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 yeah. I get excited. I get all fired up because I'm like, isn't this cool? Right? I'm like, ball from
Mhm.
here, and do them. So I get a
Right.
little excited over it, but at the same time, I have witnessed, right? And this comes in hindsight, where I've witnessed successful case studies of people doing that. And I have two clients, I know their names, that were not successful by doing that.
Mhm.
And for those two clients, not that the strategy caused them to be in a lapse pending situation on their life insurance policy. That's not what, that it wasn't the strategy, it was their income changing
Mhm.
in the process.
Right.
One of those clients lost their income for a period of time. They went outside of my rules of leverage that I display on my channel every time I do a case study. I go over my rules of leverage
Mhm.
and why I don't breach this and why I don't do that. And so it was a combination of their income interrupting or lower income situations, or expenses rising for the other client, expenses rising, and then now the strategy is starting to tighten and it becomes confusing now because it's not working the way they panned out. Life happened. And so we've got this issue. So for what Jay is asking is more than likely coming from content I've put out over the years. And I know it probably has some pros and cons of people trying to do it on their own. I'm someone that, and I could kind of like illustrate it on the board here so you can see where my finances are today. How I actually do this is I have my income that, goes into a checking account, and that checking account is of a first lien HELOC. Right, so I have a first lien HELOC on my primary property, and then from that first lien HELOC, I'm funding 4 policies, 2 on myself, 1 on my fiance, 1 on my mom, and then I'm implementing a 5th on my younger sister and a 6th on my older sister, and just getting the whole family building that whole banking system as is taught in the infinite banking world. Right. And then I take policy loans, right? It parks in the first lien for a temporary period of time, and then it goes to investments, right? Which the investments are me, like personal development, my YouTube channel, bringing on an assistant finally in my business. So I have a private assistant now, and building a team around me, and expanding my knowledge and influence and impact to create more cash flow, which that cash flow parks in the HELOC, which pays down, lowers the interest cost to borrow. Meanwhile, my interest is guaranteed, compounding, right, every single year. And then I'm creating this term that I know Caleb hates. It's positive arbitrage. Shout out to Caleb.
Right.
So that right there, I know it's crazy. For me, it seems so simple. And maybe a guy like Jay, maybe like yourself, it's like, I get it. I get what he's doing. And I've got leverage rules in all of this. I don't leverage more than 66% over here, more than 66% over here. I even have cash reserves over here, totally outside of the system. If all hell broke loose, I've got cash liquid over here reserved that I can inject into here to feed the strategy and quote unquote buy time to recover from whatever hell that broke loose in my life. So it's like I've got stuff around here to protect this strategy, but ultimately it's the idea of being able to use money more than one time over and over again. Now, could this be something, is this something you actually looked at before in the past, or you're familiar with, or you've done it yourself, or know clients that talk about it? Because that's basically what Jay is asking.
Right.
And I guess what would be some things that you would want him to maybe do in advance or be aware of for Jay?
Yeah. So, by the way, this is the kind of the first time me seeing anyone articulate what and how you're doing. So great. I mean, it's great. It's awesome. I like it. Right. Is it for everybody? Absolutely not. Right. I think for, unless you're like me and Denzel, we sit here and just go like, okay, how do we do, we love the intricacies. For most people, they should not be doing this at all. It's not that there's anything wrong with the strategy, but it is the overwhelm and the confusion that's going to kill the implementation process. That's the problem. So what we've been doing for our clients over the last 4 years, when this conversation is brought up, is we tell them, hey, it's a different, you can go crazy and super advanced, sure. What's more probable and what's more likely is that we want to help you make the first step, implementing it as simple as possible. We want to give you confidence. We want to give you the ability to go and say, hey, this thing is working. What's next? Because I think if you overwhelm people, game over, right? A lot of them will just kind of tap out and quit.
Mm-hmm.
So what we've been telling our clients is, hey, infinite banking is a whole different goal. Paying off your mortgage is one thing. Infinite banking could be a different thing.
Correct.
So what we have been informing is, hey, we can do a couple scenarios. None of these are right or wrong. It's just what is best fit for the scenario. So I've had clients who say, hey, I really want to do the IBC, but I also want to not pay much interest. Okay. For that scenario, what we've done is that individual has gone to a point, have used accelerator banking for maybe about a year or two, gotten to a point where now their mortgage payments have kind of flipped over to where it's more principal and less interest, right? It's
Mm-hmm.
kind of like 70% principal, 30% interest, right?
Okay.
They flipped the
Yeah.
ratio on the amortization payment. So they got to that point, like, you know what? I'm happy here. I'm going to now throw my extra cash flow to now funding my IBC policies. And for that person, it worked out because now their payments every month is a little bit more efficient towards paying down their principal. But now they're also funding the IBC. Another scenario is an individual who instead from day one, instead of getting them a whole life policy, they went and got what's called a convertible term policy. And so they knew that, yeah, I can pay this off in, I can pay off my mortgage in about 5 years, right? And this is just a case study. And I know that I want to do IBC afterwards, but at the same time, I want to keep my premiums relatively low. They went and got a convertible term policy, which allows them to convert the term into a whole life policy later down the road, be able to bypass the underwriting process, and they're able to secure a lower premium for their whole life policy cost versus them getting it 5 years later. So they were able to do that. So they focused on one thing at a time, paid off their mortgage, freed up their cash flow, converted the term into whole life. Boom, they're well on their way with their IBC. Granted, yes, they're going to miss out on 5 years of compounding interest, which could be a lot. I mean, you can make the argument saying, "Oh man, that's a lot of time that you lost." Sure. I've had another scenario where the individual is going to pay off their mortgage in 2 years. And this is a high income earning individual, lots of cash flow. So let me just paint that picture accurately. So what they did is, you know what? I'm going to actually on purpose pay this off in 5 years, sacrifice a little bit of my cash flow going towards the mortgage and the HELOC, and set it aside for IBC because I want to take advantage of the 5 years of compounding or whatever the years compounding interest that I could have.
Yes.
So, I mean, all different scenarios. It can be applied to different goals that you have. I like IBC. I love infinite banking. I do it myself. I have several policies myself as well. But it all depends on what you want at the end of the day. It
Yeah.
really is. There's no right or wrong in any of these scenarios.
Mm-hmm. In hindsight, there's one factor that I now use to measure the individual, and I wrote it on the whiteboard here, is in order for this, I believe, to work well, not just work, but work well,
Mhm.
is the person has to be a value creator with the intent of I'm going to increase my income dramatically in
Right.
this process. And so when I started this, like I was making a certain dollar amount, and over the years, I've either been able to increase or maintain that income without increasing lifestyle too dramatically, right? Even
Yes.
with inflation and taxes and all that stuff, life happening. That's where I use that one measurement along with others, but I'd say this is like the main thing for something like this. So to Jay listening, like that's what I would do in that
Mhm.
scenarios. Think about that. And
Right.
I also do not believe that you should use 100% of your HELOC to fund the IBC
Right.
policy. What I like to do, I've got my little funding mechanism. If I got a $50,000 HELOC and I've got $1,500 in cash flow per month, I'll do 66% of the 50. I'll take 1,500 times 12. And I say, look, here's your range. I would not go past 33. And basically letting them know if you fund a policy at 18,000 a year, that's basically 100% of your cash flow is now going into this policy. What I like
Yeah.
to see is I would like you to have $18,000 day one to fund the first year's funding on that policy outside of the HELOC, right? That's what I like to see, where
Mhm.
so you got first year's funding already in savings over here, and you're just going to reroute where you were saving money at the bank to the
Right.
policy. And then 12 months from now, let's say we funded it at 18,000 a year with the ability to go up to 25. So then 12 months from now, you should probably have somewhere around 18 grand. And whatever we're short, that's where I pull from my HELOC to make up for that difference. And then I'm just doing
Mhm.
Velocity Bank for a couple months, zero it out, and then no longer using Velocity Banking, and then figuring out what are we doing with the policy. All right. So I think that's
Right.
way more efficient than where I have seen people literally do 100% borrow from their line of credit and tell themselves, I'm earning interest on the bank's money, and then I'm creating some kind of offset. And I'm like, no, no, you're not. Sorry to tell you this. You're actually paying interest in two locations now, your HELOC
Right.
and the policy. And it takes a
Absolutely
few
right.
years. It takes a few years for that policy interest to actually like look like something. Um,
Right.
so that's it there. Let's see. Do I have more time with you to go into some other questions
Yeah, a
or
few more minutes, I think. Yeah,
more
if
minutes?
there's any more questions, for sure.
Yeah, I'm gonna scroll here. I'm seeing just good comments.
Mhm.
I have a 0% credit card. How do you pay off debt with Velocity using this? I typically just simply want that person to have some sort of another tool, personal line of credit or HELOC, and then I'm either using the 0% card to do a balance transfer on the same debt. Like let's say it's like a $30,000 car, and maybe I do a 15K chunk on the PLOC and then 15 on the credit card or something like that, if it makes sense, to just
Mhm.
get the whole thing done. And now the cash flow is going into the PLOC, and then I'm just servicing the payment on the credit card for 21 months, do something like that. Other times I will use the credit card to just run bills, like switch from monthly to annual, cover like a good amount of consistent bills for the whole year. That gives me temporary cash flow to now drive
Right.
toward that car loan or car debt. Is there anything else that you like to use 0% credit cards for as it relates
Yeah,
to accelerated banking?
yeah, I've always not. From our philosophy at Accelerator Banking has always been just a purist for line of credit, right? Because we use credit cards for sure for expense holding for 30 days and getting the interest free float, right? And being able to pay it all off and zero it out so that you don't owe any credit card interest. Obviously, the benefit that we oftentimes talk about is points and cashback rewards, right? I personally like points just because, as a business owner, there are tax ramification of using points versus cashback. Points I can actually do some certain travel tax free, which is great. So I've always been a fan of using points and cashback rewards, but I've not really preached nor advocated. Not that I'm against it, but really using 0% credit cards a whole lot, just because it's in one extra factor that we're considering. So again, I like to just stay a purist, keep it simple as possible for the average people. But
Yeah,
again, that depends on the sophistication level of the user. So
exactly. You are
yeah,
adding another layer. And
right,
again, in hindsight, I've had clients that it's unfortunate as the teacher because you say something, but how the student receives it could be a whole different thing. And
right,
as you mentioned earlier, you and I are not texting each other every day. We don't sleep in the same house together, right? So
right,
just like with our clients, we don't go to bed with them. We don't we're not seeing them every single day. So you say one thing, and then sometimes they can really stretch that. So I've had clients where I'm like, sure, go get one card. They come back to me with five. And I'm like, what did you
right,
do? Oh my goodness.
yeah,
Now we got to, and then it's like, Denzel, this one expires in September. This one expires in December. No, November. This one expires in February. No,
oh
March.
my god,
And they don't know,
right,
and I don't know. And now we're in a bunch of I don't knows, right? And that can become
right,
a huge problem.
yeah,
So I've learned that over the years as well, where I wouldn't say I'm feel a full purist, but I do recognize the value, and obviously you do as well. And you mentioned it. The third way of using the credit card is just saying, "Hey, could we just maybe use the 0% card as an interest float on your main tool,
Right.
and not maybe double chunk, right? Because if you double chunk,
Right.
it could be an over leveraged position if you
Correct.
don't fulfill that expiration date in time. Worst case scenario is you stick it back into the PLOC, right? Which would have just been your
Right.
second chunk, right? You just did
Right.
it earlier, right?
Mm-hmm.
So
Mm-hmm.
I see that, risk.
Yeah.
And again, this is good, back and forth, seeing, again, it's like we're on the, we're balancing on that wire, right?
Right.
Those people that balance with the big pole or whatever, like it's it's a scenario case by case sort of thing. Let me see if I can find another question here. Got a lot of just good comments overall. People using the Money Max account system to help them with
Mhm.
velocity banking. I think that can be good as well. Like having a software. I believe your team also has an Excel or some sort of spreadsheet that helps people track
Mhm.
their progress. Um, let's see. Uh, Trying to see if I look at anything else. Says, hey Sam, I'm currently reading 0 to 75 units in 1 year. Daniel mentions having meetups in the area. Are you guys still hosting these types of meetups, or can you recommend some in the Illinois area? Yeah, he's not too far from you guys. And
Oh,
actually,
okay.
Daniel, I don't know if you met him, but he
Yeah,
was
we met him at the restaurant, I think.
exactly. Yeah, yeah, yeah.
Yeah, yeah, yeah. Yeah, so for Tim, yeah, we do meet actually virtually now. And we've been wanting to revive the in-person meetups. And I think we have plans for it, probably in the future. But yeah, for now we do virtually. And again, not shy about telling you what we do, but we also have a real estate investing program that actually Denzel's part of as well. We meet every week on that. So yeah, so we do have meetings, just we paused any in-person meetings for now. Yeah.
Gotcha, gotcha. This is just like a comment here. I hope you guys might be able to invent new products in notes industry with velocity banking benefits all of us against banks. So that's a good idea there. And then
Yeah.
last question here, and I'll let you go. My car loan's at 6%, but my PLOC is at 13%. Is it still better to use the PLOC and chunk it? So when I see more than double the rate, sometimes I sort of like, I don't just say yes right away. I'm like, I gotta look at the math. And more often than not,
Right.
I'm probably gonna say no
Right.
because,
I would say so too.
yeah, because I could either A, for Larry, I would see, does he have a home? And could I get a home equity line of credit for much lower than that? And
Right.
then B, I'm gonna find out with Larry, where are we at on that 6% car loan?
Correct.
Are we at the final 2 years on it, or are we literally 1 month
Right.
in? Because that does change the conversation.
Correct.
Even if we had a HELOC at like 8%, if you're at the tail
Mhm.
end, eh, we're talking dollars and cents in savings probably. It's
Yeah.
not like I like to see nice, like big results in that regard. And I would say more often than not, a lot of people watching, catching the recording, watching other YouTube videos, they're trying to force velocity banking, accelerated banking into their strategy instead of
Mhm.
what I like to preach about is all the pregame work that comes with getting into the strategy. There's a
Right.
ton of pregame work that we could do to increase cash flow, build your credit, get access to a better credit line, become a better steward over your finances. And by the time all that happens, we might have already gotten rid of the car and credit card or two here, and then you're just
Right.
left with the mortgage. All right. So,
Right.
anything you would add
Yeah.
there
With
before we close out?
Yeah, with car loans, it's kind of tricky because when you pay it off, the asset's so depreciated that kind of like, what's the point? I mean, I have different schools of thoughts. Yeah, you can do the accelerated banking, velocity banking on a car note to free up cash flow, right? That's, I guess, one instance where you can kind of come out on the top.
Mm-hmm.
Um, like Denzel was saying, where are you in the amortization process can definitely change, the implementation of it. My gut tells me you're better off leaving car loans alone. Again, a lot of times it's a depreciating asset. Really, I don't, because you can't take equity out. You can't refinance a car loan to take money out. So there's no real inherent value of having a paid off car. It just really isn't. But again, just
Other than the
if
fact of
yeah,
you not having the obligation of the payment. That's about it.
correct. Yeah, and cash flow, obviously, that's an aspect where I can see, yeah, if the goal is peace of mind, and if the payoff and the interest is going to be relatively the same, if the goal is peace of mind and that's what comes ahead, great. Maybe that's the goal, right? If I want to not worry about a car payment, not have to worry about an extra thing, okay, then maybe we can optimize our decision towards that, right? So, yeah. So I guess the answer is it depends, right?
Gotcha. Let's see. He says only in second year of 5-year free up cash flow is the goal. So yeah, if we're like you see more towards leaning towards cash flow, then just knowing that yes, in your example there, yes, it's done, but you didn't necessarily gain other than the freed up obligation of the payment itself. There still is a loss in that. In that example of not paying off your car loan, right? If someone were to not do it, what's the other path? Is it invest? Is it, figure out what their value is in the marketplace and expand on that? What are you thinking?
Assuming that they don't have a mortgage or any other
Correct.
debt,
Yeah.
yeah, I would say for sure value creation, invest in yourself, right?
Yeah.
I like when Alex Hormozy says SME 500, right?
Yes.
Not
Yeah. Yeah.
S&P 500, right?
Uh,
Invest in yourself, right? Grow in value creation. That for sure. Even Dave Ramsey talks about that, right? How do you increase your income production capabilities? That's the biggest thing. So when it comes to Tim's question, how can I reach you or get involved? Are you more so asking about real estate or accelerated banking? Because I think I
I'm
can
pretty
get you a
sure
different
on
link
the
for.
real estate. I'm pretty sure on the real estate side.
Okay.
Yeah.
So for that, it's denzel.passiveincomemastery.com. So it's spelled
Awesome.
exactly the way it is, denzel.passiveincomemastery.com. So
So it's literally this link slash instead of accelerated banking, do Denzel dot. Say it again. Passive.
yeah, passiveincomemastery.com. Yeah.
Gotcha. Perfect.
Yeah.
Perfect. So we'll close with that. Thank you, man. This has been good. We're gonna do more of this. I can't wait to see what else that you could not say today that I think I know
Right.
behind the scenes
Sure.
in terms of
Yeah.
what's going to be rolling out with your company and just what you're doing overall.
Mhm.
But it's been great
Yeah.
having you here, taking a deep dive. This was a serious masterclass here, just on the
Mhm.
concept, what's going on in the marketplace. And those of you that want to work with Sam's team, it's basically me times like 20 plus people. Like imagine having a whole entire team help you on your debt elimination strategy. That's where I know Sam and his team provide a tremendous value. And then there's accountability, there's consistent coaching. It's lifetime, right? So you invest with them once and you have lifetime access to that team to help you on your debt. Now, not that it should take a lifetime, but the fact that they're with you, right? And then there's a season of which you then graduate to the next, which would be the passive investing
Right.
part, right? Passive income mastery, right? Where we can get into the real estate part and potentially use those same strategies that we were using to
Mhm.
eliminate debt, but now we're using to create income and cash flow and ultimately financial freedom, retire early, all those wonderful things that we want to be able to do. So thank you again, Sam.
Mhm.
Appreciate your time today. God
Yeah.
bless everyone. Have a good day,
Thanks,
and we'll be
Denzel.
talking soon.
Yeah.
Bye now.